All right, we are live. Thank you everyone for joining us. We can't wait to answer your questions, but this video is really going to be talking about the future cut by the Fed, which is expected on Wednesday, and the impact to our housing market and mortgage rates as well. We'll wait a couple minutes for people to join on here. It's been a while since we've done a live stream, Jim. I think about, 10 months, something like that?
Yeah, I think we're getting the cobwebs off the live stream here.
Yeah, I got to learn how to talk because editing really filters that all out. Well, of course, I'm joined by Jim Black, who's been a licensed loan officer for
Couple of years.
22 years, Jim?
Yeah, a
Something
couple
like
years.
22
A few years for sure. Yeah, it's been fun.
So we see Steve is on here. Good to see you, Steve. A longtime supporter of both of my YouTube channels. So good to see you here. He's also in Sacramento as well. So let's kind of talk about what's going to happen on Wednesday and how that can impact our market, the Batman and Robin. So my question for Steve is, who is Batman and who is Robin? So anyways, all right. So let's talk about that. So it's widely expected the Fed is going to cut interest rates on Wednesday, but what interest rate does the Fed actually control, Jim? Because this is the reason why I'm asking this, by the way, before you answer, sorry for the question, is that I've been seeing comments from people who say that I'm going to wait for the Fed to cut interest rates because I want to see lower mortgage rates. But the Fed does not control mortgage rates. Instead, they control the federal funds rate. So, Jim, maybe you can kind of talk about that here briefly.
Yeah, absolutely. So the federal government's job is to really just make sure that they keep inflation under control and also spur economic growth when there seems to be a downturn. We had some bad job reports that came out recently, which are making it more likely for the Fed to lower the rate. So what that rate affects directly are things like over-the-counter rates or short-term interest rates for things that are basically like lines of credit, credit card debt, anything that's basically a short-term debt instrument. The government is trying to get under control or readjust or realign to make sure that it smooths out any type of downside or upside in the marketplace. So generally they move faster on the way up than they do on the way down. Normally you try to ratchet things as things are spurring out of control and inflation's going up. You make bigger rational decisions to shock the market. When things go down, it's more of a slowing curve to have what they call a soft landing, so to speak. A lot of economists will talk about landing the plane. And basically what you're trying to do is create a smooth softening of things so that there's no shock to the system and people don't get nervous and panic. And the Federal Reserve's job is to have the 7 members that are involved with Congress to do that, along with the 18 voting members that actually make up the plot map or the dot plot map, which talks about their way that they evaluate their median average assessment if rates should be lowered or not. It's basically the Fed's way of doing it anonymously to say on a scale of maybe 0 to a lowering of interest rates if they're going to adjust them. So a lot of times those people have a range of 0.5% in that forecast. So it'll be interesting. That report comes out tomorrow, I believe.
Wednesday. Yeah, Wednesday.
Wednesday. The report comes out tomorrow, Wednesday, excuse me. And on that report, we'll see not only the forecast of rates in the short run, but the long run plan also. And that's where you see long-term rates be affected by that long-term forecast.
Yeah.
So right now, I believe personally that interest rates for the long run have already been baked into the last couple of weeks of economic and job data. And that's why we're seeing the 10-year Treasury today on September 15th hover right around 4 to 4.02% today. And that's where we are in today's world. So people that wait for the Federal Reserve to lower their rates, congratulations. Your line of credit, your short-term rate will adjust directly with that, but the long-term rate might even go higher, ironically, than lower.
Yeah, absolutely. So the Fed controls the federal funds rate, like Jim mentioned, and that's the short-term overnight rate that banks charge each other due to reserve requirements. They do not control mortgage rates. So if you guys have a HELOC balance, if you have money in a savings account, you're going to see an adjustment in your interest rate there. Obviously, if you have debt, you're going to see a decrease in your interest rate. Or if you're looking to get a new CD, new auto loan, the auto loan rates will be lower. And of course, your savings accounts as well. So they really control those short-term rates. But when the Fed adjusts the federal funds rate, they don't adjust mortgage rates. So what's really important, which Jim's kind of alluded to, is that the Fed on Wednesday, which is on September 17th.
17th, yep. Normally about 11 a.m. Pacific Coast time, Pacific Standard Time. Yep.
Right. So they're going to announce that it's widely expected they're going to cut interest rates by 25 basis points on Wednesday. I think there's like a 97% chance. Let me just show you guys that right now. There's a strong likelihood that the Fed's going to cut interest rates on that day. Let me just share my screen with you guys. Excuse me, which is this tool right here. So this is the FedWatch tool, and it's from the CME group. You can just Google FedWatch tool. It takes you here. It shows the likelihood, the probability that the Fed's going to decrease rates. So by 95.9%. Can you see that, Jim?
I'd zoom in a little bit.
We are live, so here we go.
There you
How's
go.
that?
That's perfect. There you go. Yeah, that looks
so
good.
There's a 95.9% probability that the Fed is going to cut interest rates by 25 basis points on Wednesday, going from 4.5 to 4.25%. And that meeting is on the 17th. Then October 29th is the next meeting. And then there's a 74% chance or probability they're going to cut rates again by 25 basis points to 4%. And then another quarter point decrease on December 10th by a 68% chance. So right now we're at 4.5%. The probability is 68%. We're going to be at 3.75%. So a 75 basis point rate decrease. But again, that's a federal funds rate, not mortgage rates. So like what Jim mentioned is that the Fed controls the federal funds rate, not mortgage rates. And therefore, the expectations or the probability of future rate cuts, we are already seeing that in current mortgage rates today. So just because the Fed decreases rates on Wednesday does not mean that mortgage rates will decrease. What is actually more important is that dot plot that Jim mentioned, because that's going to show their forecasts for what they do expect to see interest rates in the long term. And that really could impact overall mortgage rates on Wednesday. So I hope that makes sense, guys.
Yep. And also, again,
the dark side, by the way.
Okay, good. All right, cool. All right, perfect. So, and again, when we talk about interest rates, a good rule of thumb, again, is every 1% difference in rate equals about 11% difference in buying power. So what you're seeing right now in the marketplace also is that buyers tend to have an advantage right now because sellers still are making concessions and having to be more flexible on their end. So the buyers really have a great position that they're in because rates have gone down about 0.5% in the last 30 days. So they have better affordability, and sellers are still giving really good credit. So there's some of these windows of time when it can be a cyclical market or a buyer's market, for example, that we're in now. And so you're starting to see that. I am seeing every day a lot more people wake up to the fact that rates are closer to 6%. And that's pretty much another way that they can get off their anchoring effect if they already own a home, right? If your rate's at 4% and it costs 7% to move, you're not likely to move. But every day that it gets closer to that 4% number, then you have more motivation or incentive to make the move because you're going to be getting a rate that's closer to the current rate you have. And life happens, so people need to move anyways. But I think you're seeing a lot of people in a pent-up environment where the anchoring effect is still very true. But once we get below that 6% number, I think it starts opening up people to a lot more ways to get out of their home and make the move to maybe a different home, a bigger home, or a smaller home.
Yeah, absolutely. So yeah, what Jim's saying here is that rates have been falling. This is mortgage rates, not the federal funds rate. So a resource I look at is the Mortgage News Daily. They survey lenders across the country. These are not our rates, not a solicitation for lending, but this is based on their own survey as of today, which is September 15th. Got those disclaimers out of the way. So the 30-year fix, 6.25%, VA around 6. Same goes for FHA, jumbo, which is high balance loans at 6.25%. If you go right here to the 30-year chart, though, and just looking at the daily rate, according to the Mortgage News Daily, you can see here we're at 6.25%. And this is basically the lowest level since early October last year. So that should impact people who are applying for loans and also for people who are doing refinances as well in the US. So let me show that with you guys. Oh my gosh. Pardon me. There's another website I want to share with you guys. And then if you guys have any questions too, feel free to pop it in the chat.
And I have a good strategy right now. If you are thinking about refinancing, you can do what's known as an extended lock for up to 60 or 90 days. If you're concerned that you don't know what way rates are going, work with a local lender to get you locked in to a longer term rate lock. And then they have a policy normally called a rate renegotiation. How that works is it's like an insurance bet. Banks don't want to go through the process of churning their applications, right? They want to fund loans. They make money off of interest. If rates move by a certain amount in a transaction period of time, a lot of companies have a rate renegotiation. That rate renegotiation allows you to normally have a better rate one time during your refinance lock period. So I recommend that every time for the borrowers we help, where you're hedging your bet, right? You can lock in the rates, see how the Fed news, the Fed information and data may affect interest rates. Ironically, 6 of the last 10 Fed moves have actually had an increase in interest rates, which is crazy to think about, right? 6 of the last 10 Fed moves in interest rates and their Fed funds rates have had an increase in rates, which is wild.
Yeah, just the opposite.
Yeah, opposite. So again, play it safe and, hedge your bet.
Absolutely. So what people are going to be looking at is not the Fed. I'm guessing it's going to be decreasing rates by 25 basis points on Wednesday. What really the market and traders are going to look at is that dot plot. So that dot plot shows that the board members believe that interest rates are going to be much lower than expected, which means more cuts by the Fed. That will cause mortgage rates to decrease. In contrast, though, if that dot plot shows a higher interest rate environment for the long term, higher than what was previously expected, that actually could cause mortgage rates to increase. So definitely be on lookout for that.
Yep, there's some good questions out there in the comments too.
Yeah, let's look at so James, thanks for your videos. Thanks for supporting the channels. The channel. I have a second YouTube channel. I'm guessing you're talking about this one. I'm in Marin. Marin County is beautiful. Moved up from the South Bay of LA. Going to be a fun few months watching what the market does. Yeah, I mean, the market's definitely softening. I just posted a California market update 2 days ago. And yeah, inventory is up by 40% statewide. So we're definitely seeing some softening, which is good news for home buyers out there. And he follows this up by The Simpsons are predicting a stock market crash in October. That's
and of course, everything that they say is definitely true. So yeah, Simpsons are our best indicators of economic conditions.
Definitely, yeah. I think everyone uses The Simpsons, right? Thanks, James. Yep. In markets such as 92336, where homes went up 200. Jim's going to look it up, the zip code. I'm not familiar.
Yeah, I'm looking up as we're talking.
Is that Bay Area, Jim?
Let's say 92336.
92, or maybe Southern California.
Yeah.
If homes went up 200,000 in the past 3 years and tariffs are killing all the warehousing jobs, biggest employers in the area, rate cuts are not going to help. 92336.
I'm looking it up. It's just taking time. My internet's a little slow. So yeah, each market, you bring up a great question. Each market acts differently. Each market is different. So yeah, it could definitely be affecting one market over the other one.
So that's like Fontana, San Bernardino County. So SoCal.
Yeah. Definitely could be the case. And that could be also big warehouse distribution centers. Maybe Amazon opened or closed a facility, or maybe a big automaker came in or moved out, or whatever, biotech, whatever it might be. And that just tells you again that real estate is so localized. So when we talk about these big trends, as you get away from like your street level and look at the city and then county and state level, these trends are harder to predict in your specific area. So again, working with the local professionals to make sure. And housing went up $200,000 in the area. So congrats for those people that own homes. But yeah, it is, Chavo, it is hard to buy when things have gone up so fast, right?
For sure.
Job, employment, and wealth doesn't go up normally that quickly.
Absolutely. Thanks to your comment there, Chavo. So Steve-O, it's hard to keep up with Jason. You're dropping videos and questionnaires like we are under attack. Hope that's in a good way. So I've been posting like questionnaires and polls on my channel to kind of like, so we can all learn from each other, because I've asked questions like, do you think that prices are going to increase or decrease this year? It's actually been really interesting hearing everyone's predictions. So yeah, it's been fun. I've been posting that every day. Do we think the Fed will drop more than 25 basis points due to all the negative pressure and such a contrast in jobs market data lately? I don't think they're going to do, Jim, you let me know your thoughts. I don't think that they're going to be doing a drastic change. I think they're going to be doing slow rate cuts unless something really falls off. If they do a rate cut and then they have a horrible jobs market, I think they could accelerate it, but I think they're going to take their time, lower the rates, and then look at incoming data to figure out what they should do next. But I don't think they're going to do a 50 basis point. What do you think, Jim?
I agree with you, because also we have conflicting data. Jobs are one of the most important indicators, but also the cost of living. And that's an inflationary thing, right? So if the cost has not gone below the Fed's target of 2% for consumption or CPI, then what ends up happening is they got to be careful not to lower it too quickly, because guess what that means? That means the cost of our milk, our beer, our whatever is going to go higher, because it's now cheaper to borrow money. So people are going to spend more money. So it's a fine line of trying to, like I said earlier, land the plane correctly, where you're landing it at the right speed and they have enough runway, and that basically you're going to make sure that you're not creating any negative noise or hysteria around consumption. So if there's like a major event, like COVID was a major event, September 11th was a major event, all those things are drastic events, you have to make those shifts very quickly to show that you're reacting fast to big, major worldwide or global events. Because our economy is also tied, tariff or no tariffs, they're tied with each other, right? Globalization is a real thing. What affects us affects other countries. If it's our exchange rate, or if it's the cost of our goods, or imports or exports, or our wages, or manufacturing, those things are all things that we have to consider when we make drastic decisions.
Absolutely. Well said. So Chavo has this inland empire, basically all warehousing jobs. Okay. Thank you guys. Love your videos. Yeah. Thank you for supporting the channel, and thanks for your questions, and hit the like button. And please subscribe. Yeah. Thank you, Steve-O.
Steve-O should get an award.
He's like, I think number one guy. I mean, he posts first comment every single video. I really appreciate you, buddy. He's in Sacramento too.
I think you should interview him one of these days, to be quite honest.
That's a good idea.
I'd try to be the first one on to make a comment if I could.
Little Mister, look at that wave. Looks like Tapu. Love surfing. Hello, guys. I was wondering if y'all had a prediction on if the prices are going to go up a lot in high income, high desirability like Santa Barbara due to lower interest rates.
I can answer that one. Yep. So one of my favorite taglines is that I'm a lifestyle lender. So lifestyle to me means people making decisions that are not necessarily monetarily focused. They're more about their overall goals, vision, dreams, or just where they are in life. So unfortunately, it's hard to find real estate around the beaches in good weather. I think you're going to see those areas continue to have a demand that obviously will outweigh the supply of any of those areas, because you can't build more houses on the beach. So I think you're going to see areas like Santa Barbara, Santa Cruz County, Orange County, Newport Beach, San Diego, Costa Mesa, all those areas continue, San Francisco, continue to have a higher desirability. I live in Santa Cruz County, and so what you see in our county is everyone in tech drives over the hill, which is about 15 miles, and they end up buying second homes or they retirement homes where I live. So those houses are not going to be moving anytime soon because people are spending more time in those houses. They're retiring there, or they're keeping them as a legacy family second home. So unfortunately, I do believe, little mister, you're right, that if you own a home, I think you're in a good position in those areas like Santa Barbara. And I think, the areas that are not in highly desirable geographic areas have more fluctuation with rates and different types of profiles.
Yeah. And if you look at a map of like home prices nationwide, the biggest increases are in the Midwest and the Northeast, where there's not enough land to build on. It's just built out for the most part. And other areas like in Florida and Texas, there's a lot of houses being built there. And because of that, that really impacts overall home prices for on the resale market as well. But areas like in Santa Barbara, where there's no land to really build on, there's going to be continued lack of supply compared to Austin, Texas, or Jacksonville, Florida, for example.
I'm actually doing a project right now, ironically, in Wisconsin. I'm flying out there tonight. 705 single family residence homes, and you get worried when you're like, oh my gosh, 700 homes in a brand new community in a area that doesn't have a lot of housing to begin with. And we did a market survey, and in that market specifically, there was 1,000 home shortage for the next 10 years. So us building 705 homes, which is going to take multiple years, is not going to be a negative effect to the overall absorption of demand. So you always want to look at the long-term planning and follow the builders, follow these smart companies that are making long-term investments, because that's where the money's going. You probably better off betting with the large banks and large home builders.
Yeah, the interesting thing about new home construction, and I really didn't grasp this concept maybe for like 4 years ago or so, is that new houses today are tomorrow's resale market, right? So when COVID hit, we were already at very low levels of inventory, and that was because we had extreme lack of home building from 2009, 2010 through 2015, really. And so because of that huge amount of, long period of time where they had a lack of home building, that overall really impact inventory nationwide, really.
Absolutely. And it's kind of crazy to think about the differences here of like 4 or 5 years ago and what we are today. And again, I think the COVID experiment taught people that they can geographically live within a 2 or 3 mile radius, 2 or 3 hour radius of their lifestyle, maybe their job or where their family is. And we've seen a lot of those markets remain pretty strong. The Airbnb markets have the ones that have been hit, like new, people that bought Airbnbs in random places thinking that they're going to rent them out all the time. And unfortunately, those markets have been hit a little bit. I like this question next. What rate can we expect for jumbo loans?
Yeah, so, actually, before we talk about that, I actually want to show something real quick, Jimmy.
Sure, please do.
Where is it? So regarding my comment there about housing starts. So here is our good Uncle Fred. The source is the U.S. Census Bureau. So you can see here the peak this is housing starts for single family houses nationwide. So housing starts is the beginning phase in building a brand new home, right? So the peak was in 2005 and then absolutely fell off a cliff in 2009. So you can see this, we had this run up after the Great Recession, but look before that. I mean, it was at very low levels here for a long time. Then COVID hit. Of course, we all know what happened. Demand skyrocketed, but this period right here was so much lower compared to the run up of the Great Recession and prior to that as well. And because of this really overall impacted inventory. Once COVID hit, we were already at very low levels. So sorry, I just wanted to share that because it's kind of really important to kind of share that. All right. So yeah, jumbo loans. Maybe Jim, if you can kind of.
I love this one. Yeah. So you have to think of it. The simple way of looking at jumbo loans is that they are normally portfolio loans on bank balance sheets. What that means is every dollar that a jumbo loan is invested out normally means they're going on the balance sheet. What that means is a bank has to hold that as an asset. So they're using a dollar for dollar normally element there. So if they're giving CDs out or a money market rate or some other thing, a savings account, that dollar is being leveraged and invested into a jumbo portfolio loan. So when there's less demand and there's more money out there, those rates are lower or similar to conventional rates. What's kind of wild in California where we live is a jumbo rate loan in some markets is loan amounts over $1,100,000 on average, which is crazy, right? When I started in this business, the average was like 275,000. So jumbo rates are unique. They have different guidelines and they're more customized to certain types of niches. They offer interest-only payments, 40-year terms, bank statement qualifications at times. Those loans are a lot more focused on a certain demographic of a borrower type. So you'll see sometimes jumbo rates, especially when you look at ARMs or adjustable rate mortgages, those rates tend to be normally a lot better. Today, ironically, look, Jason, on your little chart there, 30-year jumbo is the same rate as 30-year fixed, far left and far right. So perfect case study right there. So again, we look at things every time we do evaluate a borrower, we look at jumbo or not jumbo. And sometimes you can even use the jumbo rate programs in a non-jumbo loan amount. Again, it comes down to the supply of money. If there's more supply out there, interest rates are lower, and banks will allow us to leverage their portfolio money to make a better interest rate option for consumers. So pretty cool. So definitely Grackle 25. Keep your eyes and ears out there, which also brings me up to the blended rate thing. A lot of people that have jumbo loans.
Sorry, before you mention the blended rates, I think that's an important thing to talk about too, is for the rate for a jumbo loan. I mean, the Mortgage News Daily is quoting, this is based on their daily survey again, not our rates, 6.25%. But so how could one figure out what would be their jumbo rate? Would you advise them to apply?
So a mortgage broker over a banker's is probably the best solution for that, because a broker will have both banking and mortgage products. If you went to a bank, they would offer their own products. So sometimes banks will be better priced in certain niches. Like maybe there's a special doctor loan program or a special down payment assistance program offered in a certain county. But normally working with a company that has a lot of solutions is where you want to go. You want your company to compete for your business. And the only way you can do that is having multiple solutions to make sure you're getting the right one. So I would look at a mortgage broker in that situation to evaluate conventional loan versus jumbo loan, portfolio loan versus a loan that is sold on the secondary.
Yeah. And then following up, Grackle, if you're still watching, let us know what state you're looking to buy. Jim, what states are you licensed in?
California, Texas, Oregon, and Florida currently, soon to be a few other ones. And that represents, ironically, about 67% of all transactions. So while I like to do loans in places like New Mexico and South Dakota, it's just the licensing requirements and the time and cost is a trade-off there. So unfortunately, I would love to be licensed in every state, but it's just sometimes not economically feasible.
Yeah, absolutely. And you're a broker as well. So if you're in either of those states, then of course reach out. And Jim, we'll go on to other people. What am I trying to say here? If you guys have any other questions, let us know. We'll talk about blended rates as well. But what's the best way to get in touch with you?
Yeah, email or text. I'll throw my stuff in the email right now. And by the way, I forgot to mention something. So we talked about years in the industry earlier when we started this thing, but we have years in life. We have someone that just turned 50 on this live YouTube thing. I don't know who he is, but this month, a certain Jason Walter just turned 50, which is really awesome. So congratulations, Jason, on turning 50. Really cool.
Yeah, you're next, buddy.
I got a long time ahead.
No, not that long.
Yeah.
Yeah.
How does
turning
it feel?
50, man.
Do you feel any different?
Yeah. I before I was 50, I was 49, and I felt old. And now I feel, and I am old at 50 years old.
Nice. Well, happy
Funny
birthday.
enough, we have exactly 50 people watching the video right now.
I didn't even know
Yeah,
it, but
so it
that
was
sounds
my
perfect.
birthday recently. So yeah, I turned 50. It's
Happy
hard to believe,
birthday.
man. Yeah. We know each other for about 75% of my life, Jim.
Oof, that's a long time. Sorry for you. Sorry for you.
And Steve would love an interview. Awesome.
Nice.
So yeah, maybe you can talk about a blended rate. So people,
Yeah.
rates are the lowest basically since October. I'm getting a lot of people reaching out. Had like multiple people last month. 3 people over the weekend. Thank you everyone for the birthday wishes. I appreciate that. Leticia,
We got
happy
some people
birthday.
from
Thank you so much.
Boston. Oh yeah, Tim.
Talk about baby face. Yeah. You can't see my gray hairs very much in the video, Steve.
Yep. AI does wonders. Artificial video.
Yeah, I just wonder. Yeah. Tiffy Mama, I'm watching from Fenway Park in Boston. That's awesome. That's cool. Right on.
Cool. All right. So let's show me this blended rate
Thank you,
sheet, brother.
Marlon.
Let me show you
All right,
this
let's have
thing.
a look at. Do you have something to share?
Yeah, I'll share it if you don't mind.
Cool. Thanks for the birthday wishes, guys.
All right, cool. So here's what we got. I'll make it a little bigger so we can all see this. So this is a blended.
Get rid of us.
This is a blended rate sheet. Got it? Okay.
Boom.
So what we're going to look at here. This is kind of a common theme. I'm going to go a little lower on the value here. So a lot of people get excited to say, I have a first rate loan at 3.25%, right? That's awesome. Congratulations. Well, what if you have other debt? What if you have other debt? Let's say that other debt was on average 7%. It pretty much means your effective blended rate is 4.5%. So what's important about that to think about is the fact that you have a blended rate of 4.5%. So when you're looking to refinance, you should be thinking about this rate here at 4.5% and this amount, not up here at 3.25%.
Yep.
A couple other factors to be aware of course, are the term of the loan, right? The term of the loan, and if it's interest only or principal and interest. Those are all factors you need to think about for your own example. But this is a big problem I see a lot is people don't realize that their effective rate is much higher than they think it is. Let's even say that I had $150,000 and those debts were student loans, car loans, credit card debts. Let's say those rates were like 9% on average. You're not too far off, from today's real interest rate on the whole thing.
Yeah, right.
So we just like to show these things.
Yeah, if you guys want access to that too, that you can send this out to people too, right, Jim?
Absolutely. Yeah. You could have extreme opposite examples. I have a credit card debt that's 15% right now. It's killing me. Well, honestly, your payment might be killing you, but your overall blended rate is pretty darn good. So this sheet can work both ways, right? In this example, you shouldn't refinance unless you can get maybe a line of credit on your house to lower that because your overall blended rate is that.
Yeah.
Again, if we change these things around and say I have a loan of $300,000 and my rate's 3.25%, and my balance here is $125,000, then absolutely want to refinance.
Yeah,
because
it's probably looking like more like a 20% rate for credit cards too.
Exactly. So in any example, it's just good to know your overall blended rate. And that's the answer for you guys to decide, not Jason or I. Without this information, how can you make a good decision? Right? Yep. The best thing you could do is find out if you should refinance or not, and when the right time to do that is. And that's the whole goal, right? Know before you owe. We try to get you in front of the right solutions and tools when you need them. So that's that sheet. I just turned that off. Oops. And I think I'm still here. Can you see me, Jason?
I can, but for some reason it's a black screen.
I think there you go. We're back. And we're back.
Jason, see, I'm 50. I'm not very tech savvy, right? So.
Yeah, Jason, you're getting older for sure.
Sternal Jet is closing. When does he say he's closing on a VA loan in Minnesota? When do you say that? October 31st at
congratulations.
What rate? 5.99%. That's awesome.
Good job. And
awesome credit score.
Yeah. And the big thing there, it looks like you're on a VA loan. It says in a couple more those chats down. Yeah. Definitely thank you for your service, number one, to our country. Obviously you want to look at unlocked currently. Okay. All right. So if you're unlocked currently, again, like we talked about earlier, most banks will have a rate renegotiation policy, which means you can lock in interest rates today. If they go higher, no harm, no foul. If they go lower, they sometimes will lower the rate accordingly. So talk with your current lender to see if they have that rate renegotiation or float down policy. Those are the two names that you commonly hear with that type of policy. And again, congratulations. Super exciting. Thanks for your service to our country. And we'll come out and visit you when you have your welcome party. So,
yeah, absolutely. So usually they have that rate negotiation once it reaches a certain level, right? It might be like a quarter point or 40 basis points spread there.
Exactly.
So, listen, I'm at 7.5%. Is it time to refinance, or should I keep panhandling?
You know what's really good is if you get those spinny signs, new construction, that's a really good job. Headphones on, spinning signs. That's what I like to do.
Yeah. I don't see much of those guys anymore. It's spin like crazy and they throw up in the air. Probably got too many traffic accidents, probably.
Yeah, nice. Right on. So when you think of this, Vito, again, opportunity cost, right? So you're at 7.5% right now. What's the opportunity cost to refinance? So if today's rates are around 6 to 6.25%, you need to think about not only the interest rate savings, but the cost to refinance. So without knowing more details, it would be important to know the loan amount size, because that would dictate if it's worth it. If your loan balance is $100,000, for example, probably wouldn't be worth it because maybe the costs are $3,000 and maybe it only saves you $40 a month. So you want to look at the cost versus savings to look at the break-even analysis on refinancing. So again, happy to be a resource for you there. But again, that's the first thing you want to look at is, hey, can I save money today? Is this worth doing? And most great lenders have no prepayment penalty. What that means is you can refinance again and again and again if rates keep dropping. So again, don't feel like you have to wait for the absolute bottom. You could have more flexibility than that. So just know.
Oh, Folsom, there you go. I used to live in El Dorado Hills. I owe $700,000 on an $800,000 home. Thinking of refi, or should I just sell and buy in El Dorado County? I'm guessing you probably bought in. I'm going to guess in late 2022.
I'm guessing you put down 5% is my guess too. That's my guess. My brother lives in Folsom. My parents live in El Dorado Hills. Wow.
Yeah.
Cool. Awesome.
Yeah.
So
refi go ahead, Jimmy.
Sorry, go ahead, Jason.
Yeah, I was just going to say, I was off by a year. Close. But 7.5%, I mean, you might want to look into refinancing given that rates are in the low, where are they, like low sixes-ish?
Yeah, about 6.25 today with an APR of about 6.3.
Yeah.
If you are, though, Vito, going to sell your property, you may not want to do anything, right? If you're going to sell it in the next couple months, don't refinance. What's the point? If you're going to keep the property as an investment property and maybe move down the road, that might be a different conversation. But if you're going to sell this property in the next 3 or 4 months, it's not worth doing anything, to be quite honest. What's the headache? Going through the headache, and go from there. So.
Yeah, absolutely. And so, I think the key thing you said, should I just sell? So I'm curious, do you want to move to El Dorado County? If you do, why spend the time and money on refinancing? And will you sell my house? I like you. Question mark? Do you like me or not? I don't know.
I like John's question. I like John's question above.
What's that?
I like John's question right above that.
There you go. But Vito, if you want to talk about your real estate goals, feel free to reach out. I'm going to post. I have all my information in my video descriptions, but let me just put my email address here. And guys, only email me if you guys are like serious. I don't want to put my information out here. Jason at meetjasonwalter.com. There you go. So Vito, you can reach out, or anyone who wants to talk about your goals in the Sacramento region, because of course I'm in Sacramento. Make sure Jason at meetjasonwalter.com. Yeah, make sure I got it. There you go. Cool. Hope that helps, Vito. And then John, top 5 things to do after closing. Go. I like that question.
I got it. I just put it in the chat room. One answer. Very easy. If you can release my email comment, that'd be great, Jason.
Did you do a private? I don't see it. You can't do it.
I
Let's
put
see
in
private
their
chat.
comments.
Sorry, I don't see your.
All right, so here's the answer. Ready? You need a home ownership hub. These are free. I just put it in the chat room.
This right here.
Yep, this one right here. Do you see the homeowner?
Got it, yeah, yep.
This is what you need to have. The reason why I bring it up is because you can look at everything from managing your house to getting services and repair specialists to looking at ways to do improvements to getting market insights, keeping track of your home value and equity. Everything you need for your home all in one place. So don't have 5 things, my friend. I got one for you. And it's pretty slick and it's free. So take a look at it. Great site, great tool, rock and roll.
So how would they gain access to that, Jim?
It's free. They can just click here, enter their home address, and claim your house.
Okay.
And you have your own home ownership hub, which is pretty slick here. And I'll put it again in the post. I don't know why I didn't post. Sorry. Tried it again there. It's still showing interesting. It's still showing failed to post. If you want to grab that, Jason, if you want to grab, I'll put it in the private chat. You just basically forward that to everybody. Okay. Anyways, it's great to stay involved with your house. You should treat your house like it's a household under management, and basically, be responsible, think ahead, plan ahead, and make sure that you're prepared if there is an opportunity to refinance or an opportunity to do something you want to do, that you have the information you need to make a good decision. And that's
one thing I'll mention too, regarding John's question. If you just bought a home, let's just say you didn't buy new. If you bought an existing house, then one thing I would, and if you got a 1-year home warranty, then put in your calendar 11 months from now to make sure that if anything breaks your home, to get it covered under your warranty. So a lot of time you buy a home, you get a 1-year warranty. So before that runs out, or before you may have to renew that, just look to see if there's anything in your house that you may want to get replaced by the home warranty company. If you bought a new home construction, 100%. Then there's a lot of other warranties associated with that. In California, I don't know if do you guys have this in what is it in where are you building at again, Jim?
Wisconsin.
Michigan? Wisconsin, yeah. Is there 1-year warranty there for builders for fit and finishes?
Yeah, every state's different. Every state's different. There could even be things in a local HOA that require certain look backs. California, for example, is 10 years.
Well, 10 years on structural
defects. Yeah. Oh, you mean the home warranty itself? Sorry.
Well, I meant I was talking about the home warranty on the resale market, but then the builder's warranty if you're buying a new home.
It's normally a few years. Yeah. It's normally a few years, and it just depends on the builder and the local jurisdiction.
Yeah. I can't think of anything else I would do right after closing. All the stuff associated with moving, of course. So if you guys have any other questions, let me know. Please comment below there. We're going to hop off here in 2 minutes, though. So everyone who's watching today's video, really appreciate you. So unless anyone has any other questions, final call. And of course, Jim, do you have any other things you want to mention?
I hope you have a great birthday month. Hopefully you get a lot of great gifts. You're a lot older than me, so please share your wisdom. Like, you should start a new channel. Over the hill realtors, over the hill real estate. But congratulations. I can't wait to celebrate with you, and I see you next time. Hopefully it's really soon. And I really appreciate having me on your show as always. And you have a great audience and great followers that really care. And it's awesome to have that engagement. So thank you.
Thanks, buddy. Yeah. If you guys have any other follow-up questions, this is live on September 15th. So if you guys have any follow-up questions, of course, you can leave a comment below. And last one, do you think I have a chance of 5.99% going down until October 31st? This is for a VA loan. Is that right? Yeah.
You'll know in the next couple of weeks for sure. I would, again, Wednesday will be a big day. I would not be surprised if rates go up a little bit on that day, and then they maybe come back down. So again, look at the overall long-term trend. Hopefully it is lowering the rates. Hopefully it is creating more affordability for all the people that want to buy a house out there. And hopefully it frees up inventory. So I'm hoping 2 things happen. 1, rates go lower, so people that bought 2022, 3, and 4 can refinance. And number 2, that it eases people moving and selling to let them know that it's okay to sell, that they won't be stuck in their house with a 3% rate. and that it should free up some inventory. So I think those
Mhm.
two things can do two good things for homeowners or people looking to buy, and maybe get someone off the fence of that were looking to rent. Now they can buy, and that's the dream, right? Homeownership's a dream, and we're honored to be part of that journey.
Yeah, absolutely. Yeah. So have a look at, I think it's 11 a.m. Pacific Standard Time on Wednesday. Looking at that dot plot, that's really going to impact the direction of rates. And thank you, Leticia, and thank you, Steve. I really appreciate you guys and everyone who watching today's video. Please like and subscribe, and we'll see you on the next video. And also, one thing I want to mention too: do you guys want to see more live streams or not so much? It's been about 10 months since Jim and I have done this, but it's fun to interact with you guys. Awesome. Yeah. All right. Cool. Everyone have an awesome day. Thank you, Jim, for joining us. Really appreciate you, buddy.
Take care.
See you, buddy. Bye.